Goods and prices. Real GDP versus nominal GDP. Real gross domestic product, GDP, is an inflation-adjusted measure that reflects the value of all goods and services produced by an economy in a given year, expressed in base year prices. Unlike nominal GDP, real GDP can account for changes in price level and provide a more accurate figure of economic growth. The nominal GDP is a macroeconomic assessment that includes current prices in its measure. The main differentiating factor between nominal GDP and GDP is nominal GDP includes inflation and is therefore normally higher than GDP.
Thus, if GDP stands for nominal GDP and GDP stands for real GDP, then GDP deflator is equal to GDP upon GDP.
GDP deflator. In economics, the GDP deflator, implicit price deflator, is a measure of the level of prices of all new domestically produced final goods and services in an economy. Like the Consumer Price Index, CPI, the GDP deflator is a measure of price inflation or deflation with respect to a specific base year. The GDP deflator of the base year itself is equal to 100. Unlike the CPI, the GDP deflator is not based on a fixed basket of goods and services. The basket for the GDP deflator is allowed to change from year to year with people's consumption and investment patterns. Consumer Price Index, CPI, and Wholesale Price Index, WPI. The Consumer Price Index, or CPI, is an economic barometer as used to gauge the sum of money which a consumer of a specific region or class has to pay to afford a basket of commodities with a view to consume it at a definite period. On the other side, the Wholesale Price Index, or WPI, can be defined as the commonly used price index which measures the price changes of the goods for voluminous sale, that is, at the initial stage of the transaction when the goods are bought by one corporation from another for reselling it.
For more such videos on all subjects, practice questions and a lot more, download iPrep and learn unlimited.